Hey, Chris.
How are you, sir?
I am good. Hey, well, we got a couple minutes before we get started. I'm going to tell you this interesting story that happened yesterday. We got a phone call from the Olathe Police Department, a detective, just giving us a heads up that one of our clients, and she's single, 73. Um, she's had dementia. We've known that. She's had dementia for some time. So at a young age, she's had this for quite some time, and she's only 73 at this point. But gave us a call that they're going to be moving her out of her house into some kind of like I want to say, like some kind of a place for care because of some sort of abuse going on in her family. That somebody in the family is supposedly abusing her. Now, I'm hearing this from my office staff, so I didn't get to talk to the detective myself. But what it did do is it threw up all kinds of red flags because it sounded like they were kind of verifying some financials in some way, is kind of the way I was interpreting this. And of course, our office is like, well, we can't share anything. You're not our client, and we don't have any kind of a subpoena or court ordered document for us to share the information with you. So I'm glad to see that those security protocols kicked in place. But afterwards, when I'm hearing that she's having some kind of like abuse in the family, again, not knowing all the facts, and maybe I didn't hear it correctly, I only know that she's got one child. And I have that one child's information in my computer, but I thought I can't call this one child to confirm this. And we tried calling our client several times with no luck. So I called my client's best friend. We have record of her, and trying to be like really encryptic, not trying
Mm-hmm.
too much, kind of thing. And I could tell she was too. But basically, we kind of got to the point that we can both tell that we both knew stuff. And I'm just trying to like, if there's anything that we should know about, would you please, let us know? But just tell whatever authorities, whatever, that we can't give information, we can't share anything without a power of attorney, without some kind of legal document. So the friend was reminding me that, yeah, she tried to work with my client and Glenn Stockton actually on trying to get her estate plan in order a few years ago, and she thinks the ball got dropped with my client maybe because of the dementia stuff and just never really got it through. And she's guessing. She says, I don't think she ever got that power of attorney in place. And here we go. Now we're at a time where we need this stuff in place.
Right.
We got to start dealing with some of the stuff. And the best friend is technically, she's going to be the power of attorney for everything, which that means I was calling the right person, but still I can't share stuff with her until I have that power of attorney. So we were really talking more in generalities, but I'm thinking, oh, she's 73. She's only 73 and has dementia. And now I'm hearing of family potential abuse. So, that's, been in this business long enough. You hear a lot of good stories, and every once in a while you hear these bad stories, and they just keep coming sometimes.
Right. The balancing act between elder abuse and fraud is kind of puts us in the middle of those two. You've got to differentiate whether you're dealing with a fraud issue or whether you're actually dealing with an abuse issue, and that's a hard thing to deal with. You're right. Until you have the legal document in place, court order, Mr. Right.
My daughter got us matching coffee mugs. Mine's
Yeah.
Mr. Right, and my wife says Mrs. Always Right. So yeah, I just thought, I'm going to pull this one out today.
Yeah, I think if my wife got me cups, hers would say I'm right, and mine would say, and I'm wrong.
All right, we gotta get started. We have on everything here.
Yes, sir.
All right. Good morning. Welcome, everybody. Thank you so much for joining us here today. My name is Mark Roberts, owner of Affinity Asset Management. And today I have my good buddy, Christian Toman, Senior Vice President at First Option Bank. Today, we're going to be talking about the topic of why can income taxes go up when I retire? This is a two-part series. Today is part two. Last week on part one, we talked about required minimum distribution, or what's referred to as RMD. Talked about the problems and the strategies that go along with that. We also talked about Roth IRA conversions and also strategies and pros and cons that come along with that. Today, in part two, we're going to add on to this, and we're going to talk about the difference between capital gains and dividends in our portfolios, as well as talking about the difference between taxable accounts and tax deferred accounts. So having said that, Chris, you and I both have clients with money in their portfolios where the accounts are being taxed at some capital gains and some dividend rates for both of them. So I thought, why don't we start off first, if you don't mind. By the way, thank you for joining us here today.
Absolutely.
But why don't you describe for the people who are following, what's the definition of a dividend? What's the definition of a capital gain? Let's start with the basic set.
Okay. The if you look fundamentally at what the difference between the two are, a dividend is income that's driven from the investment. In other words, if I own a piece of property and I collect rents and I pay those rents out to the owners, that rent is an equivalent of a dividend. That is money that's flowing through the investment to the owner. A capital gain is when you purchase an asset and you pay X for it, and at a point in the future, you sell that for X plus, hopefully for X plus a percentage gain, then that the difference between what you paid for it, which is your cost basis, and what you sold it for, which would be the proceeds, would be the capital gain. So when we buy investments, when we have pieces in portfolios, the idea there is to balance capital gains and dividends depending on the individual's needs. You and I deal a lot with risk tolerance, and most people take a look at risk tolerance as being a factor of, well, it's really a fear factor for them. How afraid am I of, how much volatility am I willing to accept? But there's another part to that that you and I both put into place when we're just making a determination how to invest somebody's money. And that is, what are their income needs from it? Is this long-term money that where they're trying to build for the future, or is it something that needs to cash flow now? Cash flow now would lend more towards a dividend portfolio. Long-term portfolio would lend more towards capital gains. Would you agree with that?
Totally. We actually have mixed bag of what clients want. Some want that long-term and some want immediate income. Although we try to explain that one is not necessarily better than the other. They just both have their different sets of pros and cons. And even somebody who wants a dividend-based portfolio, they want, let's say, less volatility in the market, a little bit more smoother of a ride because they have a steady stream of dividends. They don't have to take the dividends out to go spend it. A lot of times they just set their portfolio up to reinvest the dividends back in to continue to grow. So I found over time, kind of like a good way that I describe the taxes to folks is, well, if you give me $10,000 and I invest it into an investment and it produces a dividend, and that dividend is, let's say, a 5% dividend, so it's going to produce a $500 dividend. Well, that $500 dividend is taxable to you. Whether it's reinvested back into the portfolio or it's paid out to you, you're going to pay tax on that $500 dividend. Whereas if it was a capital gains type investment, you put $10,000 into an investment, it grew 5%. Now it's up to $10,500. It's not taxable until you sell it. Until you sell it at $10,500 and then lock in that gain and make that gain become a reality. So a dividend is going to be taxable regardless of whether they take the money out or not, where capital gains is not always taxable. So I usually walk them through that. Do you ever get into the semantics of the long term and the short term of that?
Absolutely. And one of the things I think that's a trap when it comes to capital gains, obviously, from a tax planning perspective, one would rather have capital gains than dividends, because if you're only looking at the tax ramifications, capital gains tax is cheaper than income tax most of the time. The problem that comes that as capital gains build up in a portfolio, as you get to a point where you have embedded gains, you begin to make decisions based upon the tax consequence as opposed to what the investment consequence is. And that can be a trap. I've seen it. Good example, General Electric, when it was, in the 80s, $90 a share range. There were people that did not want to sell it because they didn't want to pay the capital gain. Well, now the General Electric is at $8.02. They don't want to sell it because they don't want to incur the loss. And invariably you get caught in that trap. And so you've got to be very careful or very disciplined when it comes to managing your capital gains tax implications.
Well said. I don't know that I've ever used the word trap, but as soon as you said it, that made instant sense to me. I usually kind of refer to it as never let the tax tail wag the dog. Mm-hmm. In other words, you should buy an investment because it's the right thing for you. You should sell and get out of that investment because it's the right thing for you. Taxes is a consequence, but it shouldn't be something that drives the decision. And you're right. I have folks that we'll work with that are new clients to us, and they bring over their portfolio from someplace else to us, and they've been sitting on the same investments for years and years and years.
Right.
It's gone up and down, up and down, up and down, but over time they've just accumulated all these capital gains, and what happens is they feel trapped that they can't diversify. They can't rebuild their portfolio to a different risk tolerance that maybe they're today. And they feel like they don't want to sell it because of the tax. So the fortunate thing that we have right now is we are at very low rates for capital gains. And I would say in my 24-year career, this is the second lowest we've ever had capital gains. I would have to imagine with the $22 trillion deficit, plus this big old stimulus package, going into recession, potentially more stimulus packages, recession is going to go up. Not recession, the deficit's going to likely go up even more. Taxes are going to have to go up.
Yes.
And that means taxes across the board, including capital gains and this kind of stuff. So it's really good right now to help people get things rebuilt while we're at lower rates. It's also a good time right now to be doing Roth conversions and things like that, potentially at lower rates. If they believe, like I believe, taxes go up, we don't have a crystal ball, but a lot of people don't realize that taxes will go up when they retire for things just like this.
One of the things that we face as a trust department is a significant number of our customers are in a payout position. We're either at a point where we're managing assets for grantors who are in retirement homes or beneficiaries who the trust is designed to support them, and there's an actual payout of that income over time. We have individuals that are in retirement that we are the successor trustee, that we are going to take over managing their assets for them when they are no longer willing or capable of doing so. But we find ourselves in a position where I would say probably, well, I can tell you because I do the calculations on a weekly basis, we pay out about 8% of the assets that we manage on an annual basis in income needs. Our charitable trusts are all 5% plus that we pay out. Individuals and some of the trusts that we have pay out more than 10% per year. So, we find ourselves needing to generate cash to be able to make those payments, move money to checking accounts for people to live on in retirement. And so balancing that dividend and capital gain implications to those individuals becomes a chess match. Would you agree with that?
Absolute. When they get to retirement time, it's like a mental shift, a paradigm shift in their thinking, because they're used to, while they're working, spending their paycheck, and then they save. Now they get to retirement time and paychecks are gone and they're no longer saving. And now they're actually spending down their savings, taking withdrawals from their savings. So I have said for years, I was very fortunate very early in my career to attend the Wharton School of Business for a very advanced program that the top 30 financial advisors in the United States got to attend. And it was all on income strategies. And I learned that whenever you take money out of an account for any reason, you take money out to spend it, you're hurting the account because you're taking a withdrawal. What we want to do is show people how to take that withdrawal and cause less harm.
Right.
And what that means is what do I sell? What do I sell this month might be different than what I sell next month or next quarter or next year. What I sell to generate that dividend or capital gain is going to matter to them, and how I do it, because their portfolio, if it's properly diversified, each investment will grow. Some will grow faster than others. Some grow slower. Some are slightly losing. They're going to do different things. And so it's important that we know on our end as advisors what we're doing when we're selling it. So when we get the income to them, the client knows I get their income every month. You talked about the 5%, the 10%, the 8% payouts that you guys do in the trust department. All they care about is they get their check. What we care about is the longevity of that money by selling the appropriate things each time to get that income. And sometimes it's capital gains based investments, and sometimes it's dividend based investments. You agree with that?
Yeah, it's interesting. People often ask me, how much money can I have in retirement? And I understand that we're drifting a little bit from the tax question, but I think it's important to what you just said. Part of the calculations that we put together, and you and I can sit down and talk to somebody in ballpark what a portfolio can produce. But a lot of that has to do with how their account is going to be structured, what their cash flow needs are, what are their other tax implications throughout the rest of their life, not just the portfolio that we're managing. And so putting those pieces together and understanding the tax effects for those individuals is integral in figuring out how much money can I put in your checking account every month and still put you in a position to accomplish everything that you've asked me to accomplish for you, not just for your generation, but also for the generations that follow. I always try and manage money in perpetuity. The last thing I want to do is manage money to run out of money for a portfolio. There are some
Yeah,
of the charitable trusts that we have that's what they're designed to do, and I have a difficult time with that because my job is to make sure that next year it's worth more than it is this year. So
yeah, every once in a while we'll get someone that says, I don't care about how much my kids get. They'll get whatever I give them. I really want to enjoy my money and I want to spend as much as I can. And of course, you and I know we understand that, but at the same time, we don't know how long they're going to live.
right.
And we don't want them to take massive withdrawals. So on the subject of, how taxes can go up in retirement time when people least expect it, part of it is because the required minimum distribution rule forcing people to take money out of their largest accounts, which are typically IRAs and 401ks, and pay taxes on it. And the IRS isn't telling them to spend it. They're just saying, hey, now it's time. You got to take this money out every year, pay taxes, or be hit with a 50% penalty. So when people take these withdrawals, if they don't need it to spend, they just turn around and resave it in what we call their taxable accounts. So you have tax deferred money now coming out, going into taxable accounts. Now, as the taxable accounts are continuing to grow over time, that's being taxed as well. And that's the term double taxation I try to refer to people. You're being taxed to take money out of your IRAs to satisfy the required minimum distribution rules. They pay their tax, they spend whatever they want to spend. The leftover comes over here into their other accounts to save it for their future. And then as those accounts grow, those taxable accounts, it gets taxed every year. That's a double tax. So we try to tell folks, for people who are dividend oriented and they want some consistency of dividends, that maybe we build your IRA portfolio to be a little bit more dividend based because it's an IRA. An IRA is going to be taxed at whatever rate it is because IRAs are fully taxable. There's no capital gains issues with IRAs. So it doesn't matter if it's a dividend or a capital gains style investment. So maybe you can put your dividend style investments into that kind of an account. And then your taxable account, you could have more capital gains style investing so that the tax is going to be that you sell on a yearly basis and rebuild and rebalance is going to be at a lower tax rate with capital gains. So it's understanding the psychology of the how to use different types of investing with the different types of accounts that they have or the different types of accounts they're going to have because of rules like RMD. And so that causes people's taxable income to go up, more taxes. It causes their Social Security tax bracket to go up, and it causes their Medicare premiums to go up, all because of these things. And with proper dividend and capital gains type investments, understanding Roth IRA rules and conversion strategies into Roth IRAs, understanding the minimum distribution rules, all that comes into play that I find most people are never talked to about that regarding their old HR department at their company, their current financial advisors. It's just all about diversify. And there's so much more to it than that.
Yeah, you obviously have a individual that you use for most of your tax pieces, and I do as well. I find it very helpful to have consistency with tax preparers, so that I know when I'm putting together a portfolio what I can expect from that CPA, what they're going to tell me for what is the best way to structure something from a tax perspective. I also know that I've got the ability to ask the questions that I need to ask about an individual's particular tax implications, and it's much more difficult if I'm dealing with 42 different CPAs.
Yeah.
Would you agree with that?
Yeah. If I can wave a magic wand, I would say for every client that works with me, I would love for them to all use the same CPA, use the CPA that I would refer to them. That'd be ideal, but I know they have established relationships with people that they trust for many years. The downside is, not to knock on CPAs, but, a lot of them think with blinders on about today. They're primarily focusing on 2020 or 2019, where you and I, we're focusing on 2020 and for the next 20 years of their life. And so we find that the advice that we give kind of conflicts with them because we're trying to maybe trigger a little tax today to save substantial tax in a lifetime, where the CPA is all focused on today. Well, hey, you have no idea what taxes will be in the future. So let's just save tax today.
It's interesting you say that. We had the discussion last week about the CPA's reaction to Roth conversions. And I had a conversation on Saturday morning. Last Saturday morning with somebody that we managed a pretty good size IRA for, and I had a conversation with him about converting a piece to a Roth because his tax picture for the year manages real estate, and so he's starting to understand how COVID is going to affect him from an income tax perspective in 2020. So I told him to go to a CPA and ask, okay, we're in a down year from an income perspective. Is this a good year to do a Roth conversion piece for him? And the CPA's immediate answer was absolutely not. And so we asked the question, well, why not? Because we don't want to pay any more taxes than we have to. That was the answer.
Blinders.
Blinders.
Yeah. Hey, so 3 tax buckets is what we call things with folks. We have tax deferred vehicles, there's taxable vehicles, and there's tax-free vehicles. I would say for us, the lion's share of the people that we work with have the bulk of their money in tax deferred, like 401ks and IRAs. But the second biggest bucket is the taxable bucket, which would be like your bank accounts, money markets, CDs, regular stocks, bonds, and mutual funds, stocks, bonds, and mutual funds that are not tied to IRAs and Roth IRAs, just regular investments. That's like the second biggest bucket. What would you say is the bulk of the money that you guys manage there? What bucket is it in?
It's the opposite of what you just said, because a significant amount of the assets that we manage are in trusts. Now, I will qualify that a little bit. We do manage a significant number of charitable trusts, charitable foundations, charitable trusts. So for the most part, those are tax-free and would actually fit into that other bucket that you haven't talked about yet. There is an excise tax on income earned by a charitable trust in excess of the amount that's paid out on an annual basis. So there is tax implications, and I'm always surprised because that tax implication is small. I'm always surprised that with people that manage that to avoid that tax, 1.5%. So they work to avoid the 1.5% tax in a charitable trust instead of managing the assets correctly. I've always been amazed by that. I mean, the tax is very small in relation to the payout to the amount of income that's generated. Be that as it may, most of what we manage is in taxable accounts. So ours, the largest bulk is taxable. The second largest bulk is tax deferred.
What do you guys usually do to recommend to people on those taxable assets how to minimize the tax effect of it? What do you guys do that kind of works within your bank?
Well, it will depend on the individual. If they're at a point where we are in that payout mode, where we're working on lifestyle, are we putting money into your checking account on a monthly basis so that you can go do the things that you want to do in retirement? It's a different conversation than it is with somebody who's in their 40s or 50s that's still working and living on the paycheck. So that being said, if we are paying out on a monthly, quarterly, annual basis, whether it be to grantors or beneficiaries, or whether it be to account owners on individual accounts, either one, I'm going to structure it differently than I would if it's somebody we're dealing with the taxable portion of money that they're setting aside for 20 years from now.
Yep.
They're setting aside for 20 years from now. I'm going to try and structure it so that there's more capital gains exposure than there is dividend exposure. That makes sense?
Yeah. I think it's obvious with your style of business, you guys have clients of a lot of different ages. A lot of it's because of beneficiaries of trusts and that kind of stuff. So you automatically have young people with a lot of assets that you're having to manage. We're not that way. I would say that without a doubt, the bulk of our clients are just before retirement years and being retired.
Right.
And so when we're dealing with that demographic, it's kind of like, all right, let's talk about your world and what do we do to create income, but what can we do to create income and minimize taxes? I like to recommend Roth IRA conversions, which triggers a tax. But if they already have a sizable amount of money in that middle bucket, what we call the taxable bucket, various investment accounts, and that's being taxed also. Now it's kind of like a double whammy. They're getting taxed on pensions and Social Securities. They're getting taxed on the growth of the middle bucket, taxable investments. And then they're getting taxed again on Roth IRA conversions. So what we found is kind of a thing that we like to talk to folks and at least give them the options to understand is maybe utilizing some kind of non-qualified tax deferred accounts. Where we take money from the middle bucket, move it over to the left bucket. When I say non-qualified, it means non-IRA based. Therefore, it's not subject to the 72 rules or required minimum distribution rules, but it allows it to grow
Sure.
on a tax deferred basis. And if we can move some stuff that's normally taxable every year, at least some of it that's taxable every year, over here that's tax deferred, then the only tax that they'll trigger on that is when they want to manually reach in, pull out money, take a withdrawal, and then pay the tax on those gains. But other than that, if they don't touch it, it continues to grow, then it's not going to be taxable. What I did is I just now reduced taxes from that middle bucket, giving them the freedom to want to move money from IRAs and start doing Roth IRA conversions. So we found a lot of times by teaching people the difference between tax deferred instruments, and they're not all the same. Not everything's a 401k or an IRA. There's other ones that are out there. And there's other things that are what we call non-qualified tax deferred accounts, but still accomplishes that tax deferral savings like an IRA does. Teach them taxable, teach them tax-free. When we do that, it's surprising. It's like, I feel like we don't sell. We're not financial salespeople like a lot of people are. I feel like we're just educating people, and they're telling us after they've understood it and hear the pros and cons, what they want to do. We just took a lot of gray and turned it into black and white.
Well, it's interesting. Back in the early 2000s, and when we started to see rates come down after the late 90s, and then we had the tech bubble crash in 2000, and then 9/11, and for the first time we saw interest rates really, well, now we would know that it's more normal than it was in the past. But I remember being able to place people in AAA rated municipal bonds with 4.5%, 5.5% coupons. You can't do that today. Today you're lucky on 30-year paper to get 2%, and it's one of those questions. Okay, so how do we create that tax deferred vehicle or tax free vehicle and push it into the future without creating problems for the investment accounts? I agree with you. One of the things to be careful with, though, on those tax deferred vehicles is I think it's also one of the more abused. As I look at portfolios come over from other financial advisors, I feel that that's the place where I see the most abuse. I see people that have sold annuity contracts to people in their IRAs, and I even just recently saw an annuity that was owned by a Roth. I do not understand the logic there, but that doesn't necessarily mean that there isn't any. I don't understand the benefit of holding a tax deferred vehicle in a tax deferred account.
Well, I have found over the years, when it comes back to just narrowing things down and giving people pros and cons, and they make their own decisions, they never come back and second guess us, never second guess you, because we just taught them right from the beginning. Everything has pros and cons, and there's no cookie cutter approach. And if you ever listen to, somebody on TV, or you read an article and that's how they're pitching something, you got to have some sensitivity to it, because they're only telling you the positive.
Right.
But everything has positives and negatives. So, having get to that, no matter what decisions we do today or what decisions they want to do today, I just tell them this is the best thing for right now, but don't have your hopes up that this is where your money's going to stay for the rest of your life, because things will change. Tax laws will change, politics or economics will change, the stock market's going to change, your personal situation is going to change, or your opinion is going to change. No big deal. When anything like that changes, we can tweak things, and we will start to make adjustments to your portfolio to move towards the new set of situations. And so I think that gives people a lot of peace of mind, knowing that, okay, I'm not putting you into something and just kind of leaving you alone for the rest of your life. This is the best thing today. We're going to manage the heck out of it, and then we'll make changes when it's appropriate.
Sure.
You have that conversation?
Can you tell me what party is going to hold office beginning in January of 2021? I can't.
I got an opinion, but it's looking bleaker and bleaker all the time. I don't know.
It's interesting. Day to day, my opinion shifts. Day to day, I say it's one direction. Then the next day, I believe it's the other direction. I don't know. And I promise that tax picture is going to change dramatically.
I agree. And I've also found that most income tax increases come in a second term of a president.
Mm-hmm.
They don't often come in first term presidents. So if Trump gets knocked off and a Democrat gets in there, let's say Biden's not likely to come right out of the gates and increase taxes in his first term because it's going to be hard to get reelected for a second term. So that's usually
depend on who holds the Senate too.
That's true. That's true. But with President Trump, right or wrong, good or bad with him, there's a higher chance of taxes going up in his second term just because he doesn't have to worry about getting reelected after that. And he's increasing taxes because he thinks that's the right thing to do for all these reasons, but he's a second termer. So I think this whole debate, the second half of this year, is going to get ugly. It seems like every year we have elections, it gets ugly. And with coronavirus and riots, economy and the stock market, there's a lot of ammunition for each other. So I think we should finish on that. I think we gave some good tidbits here on taxes. I want to thank everybody for joining us here today. You have some follow-up questions, don't hesitate to reach out and contact Chris at his office directly, or reach out at us at Affinity Asset Management and give us a call with questions. Chris, any parting words?
Just that I'm looking forward to next week conversation Glenn and I are going to have about charitable planning, charitable giving, which I think will be very interesting.
And that's a great segue following in off of the taxes we talked about this week, how you can do charitable planning with certain retirement accounts and help benefit you tax-wise while helping others and charities in need. So I'm looking forward to that topic as well. I won't be on that discussion, but I know you and Glenn will kill it. So thank you so much, Chris. It was great to see you. Thanks for joining me here today.
Good
Everybody be healthy,
Mark.
be safe.
Have a good day.
Thanks, buddy. You too.
Everyone getting booted?
What do you think?
Hang on just a second.
Mm-hmm.
Yep. I need to-
So how you doing it? Hold on. There's nobody just texted out.
No. Did you gotta keep pressing there? So
That was a good one.
Didn't mean to take that political. I apologize.
Nah, it's all right. It wasn't.